You can invest in the stock market without doing dividend investing. If you need to get an income from your stocks, you can just sell small. But the difference with property is you can't sell small. You can't just sell 4% of a property every year. Dividends are out of your hands. The fees are guaranteed, but the yield is not guaranteed. Don't just follow yields blindly. Hello everyone, my name is Mudupe and today we'll be talking about dividend investing. Today we'll shift to passive income. Let me be clear. You can invest in the stock market without doing dividend investing. Whether your returns are coming from the capital gains, meaning the stock price is growing over time, or they come through dividends, it's all a matter of preference. For a long time, I preferred dividend investing when I was in Nigeria, and only in the last 2-3 years have I more or less started to shift more towards ETF investing because it's just easier and less time consuming. Dividend investing requires a bit more effort, but I just want you to know you are not behind if you don't do it. It's not a prerequisite to make money from the stock market. If you need to get an income from your stocks and you are not doing dividend investing, you can just sell small. You can sell the ETF that has grown, so you sell part of that profit. Quick reminder, everything we cover in this video is for education only. It's not meant to be investment advice. Investments can go up and down. Your capital is always at risk. If you need financial advice, please consult a licensed professional. There's a 4% rule that people usually use to say if you only sell 4% of your stocks every year, your portfolio will stay fine because the growth of your portfolio is usually on average more than 4% year on year. On average, it's about 7% year on year. So if you're only selling 4%, you're only taking the profit on top. The issue with that though is you do that when you're more or less ready to coast, because you limit our compounding factors because you're taking out of the investment instead of leaving the whole thing to grow and continue to compound over time. It's something similar that applies to dividends because dividends are essentially you taking a part of your investment. It's just that you're not the one that decides how much of the investment you take. So if you were doing growth stocks or ETFs, for instance, you could say every year I'll take 4% of my investments. I'll just sell 4% at the top, the growth that I got, basically, because if your portfolio grows by 7% and you sell only 4%, you still have a 3% growth left in there and the whole thing continues to grow. So you could decide you are taking only 4% year on year. S&P 500 has been growing roughly 11% for the past 5 years. So if someone was only taking 4%, they will still have like a 6% on top that is still growing by. So you could do it that way, or you could say, I want to do dividends. Now, because dividends are out of your hands, you're leaving it to the company to say, okay, we've made this much money and this is how much of it we'll give you and the rest we'll reinvest into the company. But either way, it's just a way to take out cash from your investments. When it comes to dividends, the cash is coming basically from the company's profits. So if companies are making profit, they probably shouldn't be paying dividends. And some people look at it the same way some people look at rent, because rent is a way to get cash from your property. You own this property and someone is living there and paying you rent, so they're giving you cash. The alternative is for you to just wait for the value of the property to go up and then you sell it. But the difference with property is you can't sell small. Unlike ETFs that you can sell small, you can't just sell 4% of a property every year. So with property, you need to have rent if you want to be getting cash regularly as passive income. That's when it's a property investment. If it's a house you live in, then that's a different conversation. Now, there are 3 main ways that you can invest to get dividends. The first one, the safest one, is again, use an ETF, use a dividend paying ETF. Let me go to Invest Engine and explore some dividend ETFs just so that we see. So if you go to investments in Invest Engine, you can actually search for dividend paying assets. So you can sort by yield, which is going to be looking at. So if you do high to low, it will sort it by the highest paying dividend companies. So you see, I don't like these ones because their TER is so high. You can get dividends without necessarily paying such high fees. So I'm just looking for something with lower fees, because the thing about fees is when it comes to ETFs, the fees are guaranteed. That fee is fixed, but the yield is not guaranteed. The yield is how much they paid maybe over the last 4 quarters. But it could also be because the price has dropped over the last 4 quarters. So they might have been paying the same amount they were paying before, but their price has been dropping, so their yield will be going up. So you really just need to be careful about just going for the highest yield. You need to understand the thing you're investing in. So you have this US, these are bonds. You know what, let me filter again. Asset class, I want equities. So we have global dividend companies. So this I like, because it's basically, if we look at it, I know the fee is high, but these companies pay dividends. That's their focus. But I don't like the fact that it's actively managed. So, we talked about actively managed funds and passively managed funds. So I don't want actively managed funds, because that means there's a fund manager somewhere, which is probably why the fee is so high. Let me see if I can, filter by accumulation of dividends. So here you have accumulation of dividends and distribution of dividends. Accumulation means that it's reinvested, so you won't get dividends from that ETF. Distribution is what you're looking for if you're looking for dividend ETF. So you click on distribution. I think we can now sort, instead of sorting by yield, let's sort by the lowest fees. So we know all of them pay dividends, but this charge the lowest fees, because there's no point getting promised a high yield when they are collecting half of it. So what are the yields that we have here? They're not too high. 3%. My own personal benchmark for dividend is 4%, because I know I can get 4% dividends from my stocks. So we have FTSE 250, which is nice, because these are UK companies and they pay 3.35. So UK companies, in my experience, generally pay more in dividends than US companies. So you see there's FTSE, where's our FTSE 250, 3.35%. And then you have this VMIDV. I've bought this before. It's also the same FTSE 250, 3.75, but it's Vanguard. I bought this once. It didn't grow that much, but the yield is good. So that's something else you notice about dividend ETFs. Their growth rates will be lower than the accumulating ones, because those ones are reinvesting and they're growing faster. So it depends on what you prioritize. Let's look at that VMID. See, a lot of them, they're not doing more than, at least the reasonable ones. Because if you want higher dividend yields, you end up looking at riskier companies. You see the fee is 0.6, which is too high in my view. I can't pay 0.6 for an ETF. So the one I used to invest in, the VMID, let's see. Yeah, so you see this. I like this one because it is, the fee is very low, 0.1. 0.1 is really low. And then the dividend yield is close to 4%, which is good. And it pays quarterly. So every quarter you have something in your account. These are all relatively decent UK companies, 250 of them. And yeah, so this is the kind of dividend ETF I would select if I were going for dividend ETFs. So dividend ETFs, more or less, they're the easiest way to get into dividend investing. The other way that some people do this is they look at REITs. REITs are real estate investment trusts. They essentially using the stock market to invest in property, because they're companies that have property holdings and then they pay you dividends from the rent that they are earning from the property. One popular one is Reality Income. They pay dividends every month. The yields are not high, but you get something from them every month. So some people like them. They call them REITs, but they're essentially companies. So at the end of the day, the way that I invest when I'm looking for dividends is by actually selecting companies. It's by selecting companies to invest in, because Reality Income is basically a company. It's just that their business is real estate. There are other companies with a wider range of businesses that also make enough money to actually pay better dividends than Reality Income. So when you're looking at individual companies, usually the yields are higher. So you see where we're struggling with ETFs we're struggling to find high yield dividend ETFs. With companies, you will see a lot of companies that pay a high yield when it comes to dividends. But the issue here is they are riskier to invest in. This is the opposite of diversification. And in some cases, those high yields are actually because the company itself has started to perform poorly and their share price has been dropping. So don't just follow yields blindly. For me, yields are the last thing I check. There are a bunch of other things that I check before I move on to yields. So this is a riskier way to invest. I wouldn't encourage this. I can give you the criteria that I use and how I find the data, but I think that's a bit more advanced. But just to know the option exists. If you compare dividend ETFs with individual stocks, ETFs are lower risk. The reward is also lower. The individual stocks are higher risk. The reward is also higher because you gain more in terms of the dividend payouts. Another area that applies here, particularly with global investors like you and I, is you could also invest in your home country depending on how the stock market performs. Now, this Nigerian stock market has been actually good. That's actually how I cut my teeth when it came to investing. That's how I learned the principles of investing and learned how to identify good companies. So you find out that a lot of the dividend paying companies in the Nigerian stock market actually pay much higher yields than what you would find in the UK. You look at something like Zenith Bank, their yields go to like 12-13% per annum. Same thing with GTB. But the challenge with investing back home is the currency risk, because you can invest there and then the currency gets devalued. That's like the biggest risk. And then there's also risk with policy, or if your money is there, how safe is it if the government decides to make some new rules about maybe being able to withdraw your investment, so cash out. So those are some of the things to consider if you choose to invest back home. But just know that usually the yields there are usually higher than the ones you find in the UK. So if I'm going to be 100% transparent, what I do is the bulk of my portfolio is in global ETFs in Invest Engine. I have a handful of stocks that I've selected on Trading 212, mostly for the dividends, and they've been performing quite well. Most of the time I always reinvest those dividends. I don't cash them out, so I don't really use it for income. I reinvest it, but I document it, so I know exactly if I were to start to live off my dividend invested, how much could I expect from it every month. So before we go, just a reminder again that don't just go chasing yield. Dividend investing, that decision on how much to pay you is being made by the company or by the ETF. You can get the same results by simply just deciding that every year I'll liquidate this percentage of my ETF growth and pay myself as dividend. You can make that call yourself. It's effectively the same result. If you check on the YouTube channel, you will find where I've actually listed out the criteria that I use to select companies to invest in. That's it for today. If you have any questions, leave it in the comments below. I'll see you then.